Hey everybody, welcome to this week's video. I'll be going over the data sets, the earnings, and the SPY technical analysis for the week of July 6th, 2026. And with that said, let's go ahead and jump straight into the data. Now this week we do have some important data, um, and let's just get right into it. So for Monday we have the second half of last week's data with the ISM manufacturing data. This week we have the non-manufacturing side. Usually they're within the same week, but because of the, 4th of July holiday, we obviously couldn't have that last week, so here it is this week. So we have the S&P Global Services and Composite PMI. Not too worried about that. Not too worried about the non-manufacturing stuff either. The one that I am kind of concerned with is the ISM non-manufacturing employment, just because we did have that very, very, very low rating of the non-farm payrolls last week. So looking at the labor market is going to be very, very crucial moving forward from this point. Now for Tuesday and Wednesday are kind of the big weeks this week, or the big days this week, but we still don't have a whole ton of data. So for Tuesday, we have the ADP weekly. Not really too worried about that unless we see a reading far underneath this 30,000. Now, just a reminder, this should be a lot closer to 50,000 to even closer to 70,000 per week. We have not seen those numbers in a very, very, very long time. So we're still missing the mark in terms of where the labor market should be. We have the exports and imports, which usually we don't track too much, but they are important because you plug those into your GDP calculator, and that's how you get part of the GDP reading. So if we have a major pull down or pull upward within these data sets, they definitely can be influential on the market. Now at 11 a.m. we have the New York Fed 1-year consumer inflation expectations. I don't really expect that to go up. Last reading was at 3.5%. I'm not seeing what other consumers are seeing if we see this continue going upward. Um, I would expect the sentiment across the board to start coming down a little bit, as with inflated prices. Usually that slows spending. We've been seeing that slower spending, but we've been seeing a lot of these soft data sets, which means they're opinion based, coming out with higher expectations. Usually not how it works. So either I'm incorrect about what I'm seeing, or the consumer inflation, or the consumer expectations overall are basically being overblown. But that's for Tuesday. Now for Wednesday, we have the Atlanta Fed GDP now for quarter two. So usually I wouldn't track this too much because this is like a weekly or bi-weekly release, but this one is the entire quarter. So this one does have a lot of weight to it. So if we see this shift downward or upward, obviously that's going to be pretty impactful on the market. Now, what the market really wants to listen to this week is the FOMC meeting minutes. Now, the meeting minutes, again, those are just going over what each of the Fed chairs, uh, were thinking about before their decision before the last FOMC meeting. Um, One thing we do know is that half the participants wanted to do a rate hike. Okay, so it's going to be kind of important to be able to read over what they're all saying, especially now that the Fed has shifted directions from kind of pushing the data out first and letting the market react to it, where now they're more so being reactionary to what the market is doing. So seeing what these Fed chairs are thinking about is going to be super, super, super important moving forward. Now, the rest of this week, really not that much. We have the jobless claims. We haven't really been seeing anything crazy in those. We've been seeing the initial claims moving up, but we've been seeing the continuing claims moving down. So, one thing that I did go over when I read over the unemployment last week, and we can Let's see if I can actually take a look at that. No, it won't let me. So last week we saw the employment rating come down. However, the U6 unemployment also came down, which means that there's less participation within the employment field. That means more people are falling off of unemployment benefits and things like that. So that can be giving us that correlation of why we're still seeing the initial claims moving up, but seeing the continued claims slowly trickling down. Are these people just getting off of the claims themselves and trying to pursue side career or side jobs and things like that where they're not having to be within that system? I'm not sure, but I do know that the initial claims have been continuing to rise. Now we could take a look at this. So let's look at the 1 year. This isn't going to help. Let's see a line chart. So they were starting to drop. Hold on. There's a specific period, unless these were heavily revised, which that might be the case at this point. So let's see, I just want to look back. They're basically showing this 220K. Last year, this time, it was closer to 250K for the initial claims. I swear it was down to 180,000 at one point, 160,000. But maybe those had revisions on them, which I'm thinking that's very likely the case because I'm not seeing that within the current data. So the overall initial claims are holding steady, but again, we don't want to be seeing this many people signing up for unemployment essentially each and every week. It's not a good thing. If the labor market was doing great, then we'd be seeing this a lot closer to, the 100,000, 120,000 range. This being at the 200, 200 plus thousand, that's pretty scary. Okay, that's really scary. Now, the thing that makes it less scary is that we do see the initial claims dropping down. But let's go over 2 year period. We were really high at one point. We were getting very, very close to that 2 million mark. So it looks like 2 years ago, July 2024, it was around 1.8 million. So still very close to that same amount. And then COVID. But even prior to that, it was very heavily leaning towards um, that 1.7 million. So we've been seeing this just slowly climb. Because if we look back even to 2022, sorry, I'm trying to get this to focus in properly. 2022 was kind of that peak of we're done with COVID, we're starting to, somewhat normalize. So we got down to 1.3 million, and we've just been climbing kind of ever since. Okay. Um, so this is something we're going to be taking a much closer look at from now on, because I do think that there is some major issues within the labor market. Last week we saw the non-farm payrolls come in, I believe at like 48,000 when it was supposed to be at like 120,000, which is still low, but that's a very, very, very low reading. So really the rest of the week, not too important. Mainly I'm looking for Wednesday for the 2 p.m. time slot for the FOMC meeting minutes. But yeah, with that said, let's go ahead and get into the earnings. Now I'm going to spoil it. There's really nothing going on with the earnings this week. So let me hide that. So the earnings this week, pretty bland. There's there's really nothing I'm interested in. So I'm not very concerned about that. But I do want to show the next page, which is the CME Fed futures, and let me make sure my Camera's on properly. Okay, so the CME Fed futures, and this is going over September. So let's just show July 29th really quick, the next meeting. Next meeting, we have a pause at basically a 78%. This was a little lower, um, but with the data coming out from last week, those non-farm payrolls, it has reduced this odds a little bit. It was closer to 75% or 70% of the chance of a pause, 30% chance of a hike. It's dropped down pretty dramatically. So we'll see how the labor market data continues to fare. If the labor market data continues to cool down, then we will continue to see this pause increase. Okay. I'm not too concerned about the July meeting. It's mainly the September meeting. Okay. Now, for the September meeting, they did have the odds of the hike much higher than the pause. Okay, the pause at one point was only 40%. Okay, compared to a 46% chance, almost 47% chance of a hike. That has shifted very, very dramatically. And we've even seen the chance of two hikes shift from that 12.6, almost 13% down to currently 9.2%. Okay, so if we continue getting cooler data, then these will shift downward while the pause continues to shift upward. Okay, now one thing that I'm going to just state openly is that with the basically the conflict in Iran starting to slow down, if it doesn't pick back up, if oil prices continue dropping, then generally it leads to deflation. Okay, if we start seeing deflation occurring, then the chance of these hikes are going to drop down very, very dramatically. And we're going to start seeing a chance of a cut again, okay, if that actually occurs. Now, for October, last week we saw the chance of a pause being at anywhere from 32 to 35%. Now they're saying only a 30%, well 30.8%, so basically 31%, while the chance of a pause or a chance of a hike is at 45.4%. However, this has shifted down a little bit, but the reason why this is shifted down is because they have started to price in potentially more hikes. Okay, so this is saying there's one hike, two hikes, three hikes. Okay, and again, this is for October, so this is forward leaning a little bit. Now for December, the chance of a pause for December has shifted pretty dramatically. Okay, last week it was at 23% that we were going to pause, with a 41% that we were going to hike once, 27% chance that we were going to hike two times. Now that's shifted a little bit, where we're now at a 23.4% chance of a pause, which that 0.4% does matter here. Okay, it is very important if we're expecting pauses. The chance of a single rate hike has shifted from the 41.8%, basically staying the same, to the 41.9%. Two hikes, 26.7%, down from a 27%. Okay. And then the chance of three hikes has shifted from 7.4% to 7.2%. So these are starting to pull down very, very slightly, whether it's shifting more into the pause or just kind of shifting into a gradual, they're expecting more hikes. We're still seeing the toss up in between. Okay, so we will be keeping tabs on these each and every week. They're going to be very important moving forward. But other than that, let's go ahead and jump right into the technicals. Trading is a skill that can last for a lifetime. Join my Patreon for live classes, my personal market analysis, premium Discord access, and direct communication with me. Invest in yourself, become a more consistent trader, and build a better future for yourself and your family. Visit patreon.com/wooksy to join today. Thank you so much, and let's return back to the video. So before we get into the technicals, I just kind of want to talk about how the 5K challenge has been going so far. Um, last week, well, I shouldn't say last week, 2 weeks ago, I had a really bad week that week. Um, I traded into a really choppy session, and pretty much every single one of my trades were going south. In terms of the 0 DTEs, I overexposed. I was not trading smart. I did take the account down to 2.8 thousand, and this last week I have recovered a very large majority of that, and I've kind of set some rules where I'm going to prevent myself from doing that any further. However, we're currently at 4.3 thousand, almost 4.4. I'm sure that'll shift a little bit depending on the positions on open, but I'm looking to try to pull this back up to over this 5,000 this week. So we'll see how that goes. Um, but again, the goal is to get 100,000 by the end of the year. I really need to get it to about that 10 to 20,000 to really start making some very, very solid trades. Until then, it's going to be a little choppy. So I'm going to focus more on safety, focus more on just slowly climbing and clawing back everything that I can. So that's the goal with that. We're going to continue trading that live on stream again Monday, Tuesday, Thursday, and Friday at 9:15 a.m. Anyway, enough about that. So going into the SPY, and I want to show the moving averages here because they are very important. Now, this is the daily time frame, okay? And you can see the ADL on the daily time frame. It has dropped massively, 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 massively. In fact, the last time it was at this point was basically during the sell-off. Um, so while we have funds flowing in to the SPY a little bit, it's nothing incredible. It's not like where it was when it was close to the all-time high. You can see the ADL over that period of time where it just absolutely starts climbing, tons of money is entering into it. Now we're starting to see a little bit of shakiness. Okay, we're starting to see these, ups and downs, up and down. Now with the moving averages here, and I want to pull out an arrow so I can explain what's going on. So with the moving averages here, you see the 5 MA about 3 weeks ago, 4 weeks ago, okay, early June, where it was pulled heavily below the 20 MA. Now that's very important because the 5 MA is the closest support we'll ever have. Okay, and what I mean by that is that every single one of these supports take time to get to. The 5 MA will always trace back to us within 5 days if we're sitting basically right at the same spot. If we're trading at the exact same level for 5 days, the 5 MA will pull back to us in that time. It'll take the 10 MA 10 days, 20 MA 20 days, so on and so forth. So our closest support is always this 5 MA. We see how the 5 MA just pulls super heavily underneath the 20 MA, pulls back up again, pulls above the 10 MA, which that is a bullish cross, starts pulling up above the 20 MA, that becomes a bullish cross. However, it gets rejected, crosses back down, that becomes very bearish, crosses back down again, becomes very bearish. But one thing we do see here is that the 10 MA and 20 MA have gone from a stance of the 10 MA being heavily underneath the 20 MA to now they're basically consolidated, and come Monday, we'll see the 10 MA actually above the 20 MA again. Okay, and we'll see the 5 MA much higher than the 20 MA. So that actually puts our moving averages in a bullish stance. One other thing I want to show here is that the 5 MA, when it was pulling down the second time, it pulled down almost to the 50 MA. Okay, and we talked about that in the last two videos, that we'd very likely see this 50 MA range. Well, we saw the 50 mile range, however, we see our 5-day support just completely bounce off of it. Okay, that's a pretty telling sign. Now, does that mean it's going to bounce off that level and then come back down and pull through it, it can. However, our moving averages are going to be in a bullish stance here. We have the 5 mile above the 10 mile, 10 mile above the 20 mile, 20 mile above the 50 mile, and the 50 mile well above the 200 mile. So technically, if the market wants to push, it has the ability to. Okay, assuming no data or anything's going to take it down. Now, structurally, and I actually want to show this with a rectangle. Structurally here, we have a cup formed. Okay, and with this cup formed, and we're going to turn off the moving averages for a moment, this creates the liquidity to pull back upward. Okay, and there's also something else I want to show here in just a moment. We had this smaller cup. It looks like it's starting to form this larger cup. I don't know why my template always defaults to that. But we have a smaller cup here formed, likely going to create a handle before pushing the upside, and that's what that dotted yellow line's meant to represent, is the top of this prior cup. Okay, that would form this much larger cup here. Then we could delete these small ones. Very likely from that range, build a handle, and then start pushing towards this all-time high, which wouldn't be too far from that point. In fact, we might even see this cup push to that level prior. So I want to mark out this on a horizontal ray really quick. But we can see this cup up at the 754.73, pull all the way to that 758. It says 759.45, but it's actually 758.45. But we can see that happen, and the reason why we could see that happen is because we do anticipate and expect bearish structure to form at the top of a cup, because that's how you get your handle. So if we're going to see continuation within this bullishness, this is something I would expect on the daily time frame. Okay. However, and this is a pretty big however, is that we've been seeing our upper Bollinger curving downward. We've been seeing our lower Bollinger pulling upward. This is heavily alluding to consolidation. Okay. And consolidation means that the move's not ready yet, but starting to build. Which means that with our moving averages turning bullish, we absolutely could see some form of major selling here, pull close to the bottom of that lower Bollinger, probably reject it, maybe even pull back into it very slightly. But from that range, we would then expect to start pulling up towards that upper Bollinger. Now, the thing with SPY and the upper Bollinger moves is that we technically have not had an upper Bollinger move since basically October 25th, something like that. Yeah, October 25th of 2025. Okay. Um, so we're very due for an upper Bollinger push on the SPY, and that would be bullish. That would be meaning that the price action will pull above the upper Bollinger. And it's actually surprising we haven't seen one in such a long time. So, is the SPY due for it? I think absolutely. I also think that potentially with the moving averages turning bullish here, we have a double bottom. Okay, and I know some people might say, oh, well, it's not aligned properly. You can have a slanted double bottom. We've seen it before. Um, I could talk about that in another video, but I'm not going to talk about it now. Um, but this can turn into a double bottom, creating that upside. Okay, and the upside from here is very, very large. This means that we'd be expecting basically all-time highs. Now, is that going to happen this week? Not entirely sure. Just based off of the moving averages, we saw the 5 mod somewhat tested last week, but it was kind of rejected and bought upward, which means that it doesn't really feel like a full 5 mile test to me. We're going to be seeing this 5 mile pulling up towards this 742, 743 range come Monday, which means that basically where the market price is right this moment, we're essentially going to be testing that level. Because we do test the level $2 above the moving average and $2 below to set the upper and lower bounds of that level. So if the 5 mile is at that 743, we should be expecting 745 all the way to 741. Okay, now the 5 mile was at that 744 or that 740 last week. Okay, on Thursday. And what happened? We pulled down to that 740 range. Let's check the hourly. Yeah, we pulled down to that 740.03 and rejected the bottom of the test. So one thing that I have seen occur before, and I've seen it occur actually multiple times, is where we do a 5 mile test within 2 sessions. So one session testing the upper bounds of that level, the next session testing the lower bounds of that level. So with this being a smaller cup, with our 5 mile being basically at that 742, 743, this gives us a lot of opportunity to retest that 5 mile, retest that lower bounds, and then really push. Okay, and this very, very likely would push all the way up to the, that 758 range. I'm not saying it's going to do that in a day, but this is how we get the liquidity to do so. Okay, and what we would also see starting to form there is an inverse head and shoulders, assuming we get this handle to the downside before pushing upward. Okay, so we're starting to see a lot of bullish structure starting to form. Okay, now we're not entirely out of the bearish structure just yet. We still have, a little bit to contend with because remember, this was a very large inverse cup. I wish my drawings wouldn't cut out like that. Pretend there's that cup there. Inverse cup with the inverse handle, which becomes a nested inverse cup, which means that if we have a rejection downward, this can absolutely become the handle of this inverse cup, okay, which would also create somewhat of a double top, and it would keep us within this selling channel. I don't have the channel drawn out right now, I do apologize. But we do have a selling channel still present there, okay? And we know that last week that semis, QQQ, the SPY have all broken out of their buying channels. Okay. Well, no, semis are still in their buying channel. No, it broke out a little bit. I apologize. So with semis breaking down, um, sorry for all my drawings here. This could mean that semis want to start heading all the way down to this 521. Okay. Which might seem like a stretch right now, but it really isn't. We've been seeing semis lose anywhere from $15 to $30 per session. So that could be literally 2 sessions away. Okay. So that's something to think about still is that while we're in this range of, potential major selling, you can see that it pretty much rejects this channel every single time we get towards the top of it. This can still create that downside. Okay, so we're not out of the woods yet, but if we can create the handle on this cup and we start actually bouncing from that 5 mile retest, then this is telling us that, okay, this channel is not going to exist anymore and we're going to head upward, which that's what I'm expecting. However, we've been seeing a lot of selling out of semiconductors. The overall semiconductor industry has been getting absolutely hammered by bad news. Last week on Thursday, if I remember correctly, OpenAI is working on a deal with Samsung to create their own chips, basically cutting out all the other semiconductor companies. And that's exactly why you see that massive candle to the downside, because with that news, that means that a lot of this money doesn't need to be in here anymore. Okay, so it's something to think about. And yeah, I think we covered everything. I know these technical analysis videos are a little shorter now compared to what I previously done, but as long as the message gets across, then that's what's important. So this week, what's really important is retesting that 5 mile and seeing what the market does with that 5 mile retest. Do we buy up from that 5 mile retest, or do we start breaking down? One thing to consider is that throughout this entire period, right in this box, that we have been heavily testing the 20 mile, the 10 mile, the 5 mile, even the 50 mile. Okay, which means that this can be grabbing all of that liquidity to push upward. So something to think about. Something we will be monitoring very closely this week. But other than that, I hope everyone had a great 4th of July. I had a pretty enjoyable time spending time with my wife and daughter. We lit some of those sparklers in the backyard. My daughter doesn't like the big fireworks yet because they scare her, but I think next year we'll be able to take her to those. Anyway, with that said, I hope everyone has a fantastic week. I hope you get a chance to watch the stream and we can go over some trades. And with that said, I will talk to you in the next video. Take care, everybody. Thank you.